the experts have weighed in and the 2025 price targets for the S&P 500 have been officially published. So we are at the end of 2024. All the big investment companies have come out and said, hey, here's what we think the S&P is going to land on at the end of 2025. Now, I've done videos in the past talking about price targets, how far they're typically off. And today we're going to say, okay, what are the expectations for 2025 from some of the biggest investment firms in the country, and how should long-term investors think about these price targets? Why are we talking about these targets in the first place? Well, I get this question all the time. Now, these are clients, we've been working together for a long time. They say, hey, Kyle, I know that everything you've told me says we can't predict what happens over the next 12 months. But I just saw this price target, or I just saw this paper projecting this rate of return in the market over the next 12 months. What do you think? And so we're going to be talking about the price targets for the 2025 year in the context of what is the motivation for these companies issuing these targets. Because if you've looked at the past, we've discussed it's incredibly difficult to predict this with any accuracy. I'll give you the clip notes. In 2024, everyone was way off, and I mean everyone. And that's pretty consistent. Pretty much every year, it's incredibly difficult to predict where the market is going. And so I think instead of calling these price targets, we should call these fun guesses. But from a motivation standpoint, why are these firms putting out these price targets? So these are the 2025 targets for the S&P 500. And as you can see, on the very top end, you've got around 7,100. And then on the bottom end, you've got around 4,400. For context, the S&P right now is around 6,000 in December. And so, okay, other than these bottom two numbers, okay, we have got price targets anywhere between up 4 to up around 15%. So up 5 to 15%. That is pretty much consistent across every single firm. Why is that? Why is everyone falling in this range of kind of high single digits, low double digits rate of return in the S&P 500? Well, if you're a really big firm, one of your key motivations is to just not look dumb. And if you know the S&P goes up on average X amount per year, it's pretty easy to just do something around that, add it to the current price of the S&P 500, and you can very easily come up with a hypothesis and some research on why that might make sense for the coming year. And so for the most part, most of these 100-page research reports, and I've read them, are a whole bunch of great data that all say the same thing. And we think the S&P 500 is going to be a little higher than it was last year. Except the challenges, and as we've discussed in prior videos, that's never how the ride is. It's an incredibly bumpy ride. So up a lot, down a lot, that's how you get to an average rate of return. It's not this consistent price target, 5 to 15% every single year. But understanding that price target is another way of saying fun guess. But again, that is their job. If you pay an economist or you pay a company to make a prediction about the next 12 months, they're going to come up with a prediction that seems rational, where they're not going to get fired so they can get paid to make it next year. No big deal. We just have to understand motivation. We have to understand what is the goal of these companies. And again, the goal of the company is to stay in business. And so for us, as long-term investors, moving this from some kind of price target that we can make good decisions around to fun guesses helps us focus from going from a 12-month number to going to a much longer-term planning view. I hope you found this helpful, and as always, thanks for investing your time with the Personal CFO.